Okay, welcome everyone. We'll start our last lesson, lesson 4. My name is Anjum Satar and my email address anjum@ukversity.co.uk. Please, if you have any question, just drop me email. In this lesson, we'll go through LO4, which is learning outcome for be able to use techniques to measure the performance and assess financial position of organization. So which will go through different organization, will assess their financial position, and on the basis of this assessment we recommend either to invest or not invest in these companies. So that will be focused in my lesson. Before starting this lesson, first of all we recap what we learned during our uh, previous lessons. So we'll start, please. So first we'll go through what we learned during lesson 1, lesson 2, and lesson 3. So we're doing ATHE level 4 diploma in accounting and finance, which you can find via Moodle, which is our VLE virtual learning environment. You click there, go unit which we are doing, unit 2, which is financial accounting, and then click your unit specification. So first lesson we discuss about understand the relationship between organization ownership and nature of financial reporting statement. So we discuss about different type of financial statement. We discuss different types of organization: sole trader, partnership, limited companies, and a non-profit organization, which is a charity. We discussed those, the set up under the Charity Act 2011. So we discussed those. We discussed IES 1, International Accounting Standard 1. We discussed how many types of financial, 4 types of financial statement those are prepared, and we see in different companies financial statement as well in lesson 1. Lesson 2, we discuss about the role of bookkeeping. So we discuss different rule of bookkeeping. We discuss debt click, double entry bookkeeping. We prepare the trial balance. Trial balance mean the end of the year, all the ledgers will be balanced to the trial balance, and then the accountant job to be prepare the final account in shape of 4 types of financial statement: statement of comprehensive income, which is also known as the profit and loss; statement of financial position, which is also known as a balance sheet; third type of statement, statement of cash flow, also known as the cash flow statement; and the last not least we discuss about statement of change in equity. So these we discussed during our second lesson. Lesson 3, we discuss about be able to prepare the financial reporting statement of different organizations. So we discuss 4 types of financial statement. We discuss end of the year adjustment, and we prepare these financial statement like from the trial balance. We prepare the statement of financial position, statement of comprehensive income, and we analyze different elements within a financial statement like asset, like liabilities, like capital. And we discuss cash under operating, financing, and investing activities. All we discussed during our last lesson. So today lesson is a lesson 4. In this lesson, we'll go through LO4. So we have 4 assessment criteria. So calculate the performance indicator. So we'll calculate the performance indicators. We develop the key performance indicator for specific business. We interpret the result. We'll analyze the rational and the qualitative and quantitative, and we compare different organization and indicators. Those will help to be either to invest or not. Then this is all our LO4 inductive contents. Liquidity ratio, which is most liquid, is quite good, near to the cash. Current asset divided by current liability, profitability ratios, working capital ratios, efficiency, and use of resources. All we discuss. So this is the inductive user of the financial statements, and we'll go through these ratios, and we can make the decision in the certain uh, different organization in different environment. So now you can rate yourself your knowledge about financial statement and financial ratios in term of, and which is in terms of the financial statement, we already discussed these statement in our other lessons as well. Okay, next now, so we'll go through our 4.1, calculate the performance indicator. So we'll calculate, before calculating, we need to explain them. If we don't know them, we can't really calculate properly. So financial statement of their own is a limited use. So for example, if you were identify the business has made the profit 1 million, so what does this tell you, the business? Does it suggest you the business is success? It might, but not. In the previous year, the profit made 50 million and the closest revival earned 60 million. So we need to look around. It is important that the user of the financial statement can interpret the financial statement below and draw the valid conclusions. So typically involve the user of financial statement, prior year forecast, competitor, user can be sales, expenses, figures, asset, liability. So all this ratios are widely used for this process for the comparison purposes. Don't forget, though, the ratios are calculated using the figures already presented, but these will help you to make the decision, and we can use the comparative figures. Okay, use of financial statement. When interpreting the financial statement, it is important to certain who the user are. So you have to look around the suppliers, lenders, management, financial institution, employees. So different users, and they have a different information they're looking with the statement and these ratios. So ratios are usually simple calculation based on the interaction in the set of data. For example, change in the cost of the sale as a direct list change in the sales of activities. The change in the sales activities also have effect upon the wages and the salaries and the receivable and inventory, and ratio allow us to see these interactions uh, in a simple, concise format. So ratios are the limited use their own. Thus, the following point need to be useful: checklist the needs and analyze the data and comments on it. So we discussed the ratios. That I'll share with you this screen full so we can see properly. Okay, so four types of ratios is current ratios. It means current asset divided by current liability. Current asset means the asset which we can use less than a year. So current liabilities is the liability which we have to pay in less than a year's time. So that's called current liabilities. Profitability, financial ratios are the position, interest cover ratios, profit from operation divided by finance cost, which is mean interest cost. So how many times our profit is higher than the finance cost. Gearing, high gear, like you drive your car, high gear is the high risk. Profitability will go through, and the use of resources, also known as efficiency ratio. So we can see there all the formulas we've been given. We can use these formula to calculate the ratio. So then next we looking the main objective of the financial statement to make the economic decisions based on these, the information on the performance. So for performance, always we look in cost, in time, in quality. So not just a financial side, but we look the a quality side, qualitative and quantitative. Qualitative is the information that's help without the numbers, and quantitative is mean numbers. The ratios are the numbers. So calculate ratios, compare set of the ratios, comments, suggest whose interpretation the interested parties and all. So return on capital employed, we be given the formula and the purpose of the ratio. Return on capital, remember here the total return by the company, the total loan, the capital, and the share capital. It judge the profit earned in the relation to the resources available. So is it how well we utilize? So every pound of investment what we generate. So return on equity. Equity mean the share capital. So profit after tax divided by equity. So you can find how many shares you have in circulation and how much per shares you generate the profit, or the return on your investment in terms of the shares. So the profit percentage of the expense ratios we can find as well. Turnover, asset turnover, how much quickly we turn the asset into the finished goods and we sold it and we earn the profit. So liquidity is quite useful to look around, because most liquid asset, it means near to the cash, and that will help the company. So it's mean less risky company if you have a more liquid asset. Okay, so Inventory turnover mean how many days inventory being converted into the finished goods, how long we hold the inventory. Trade receivable, how quick we are receiving the money from our debtors. And creditors, how long we are taking to pay our creditors. So working capital cycle, we can inventory turnover days plus receivable days minus payable days. Increase in these periods can be significant liquidity problem. So we need to be make sure we have a good, the safety net in between this receivable days and payable days. Financial position, as mentioned earlier, is shows high the gearing ratio, high the risk. If you have a higher, so we look around the gearing ratios, we look the interest cover ratios. And now I'm giving you example and which we'll go through now. So before, so we need to look around this question. And I'll upload these first. So we have been given the two companies. One is a Anika, one is a Papika. So we have two companies, Anika and Papika. We've been given their statements. We've been given the income statement, which is also known as statement of comprehensive income or the profit and loss two companies. We've been given the revenue. We've been given the cost. So we can see how much was the revenue last year, this year. So we can see how much is cost and how much is the profit. So Anika's is profit is more than Papika's. So not last year we can comparing with one company with other company. We can compare one company 2 year statements as well. Or both company 2 years we can look around. So that's we need to look around. Then we can go through the distribution costs, administrative expenses, profit from operation, finance costs, and profit before tax. So all this and the tax. So then we can look around profit for the period, continuous operation attribute to the equity holders we been given. And then we can look around Nika and Papika's non-current asset, current assets. And then on the basis of this, we can use the formulas. We've been asked this. Using the formula, calculate the ratios, which we will calculate these ratios, comments on the ratios, and then advice and the reason to make a decision. So we look here based on, so we see here, so gross profit divided by the sales, which is also known as the revenue. So is it 45%, other is a Papika is 52%. Then we look at Nika 9%, 11%. Gearing ratio 13%, 71%, and we look around the interest cover ratios 11 times, 3 times, 1.2. So all this based off this, we can look around because Papika is more profitability, is less risky in terms of the profit because they have a high profit. But in terms of Anika is less gearing ratios, it means less risky company compared to. So as we learn, it's higher the risk, higher the return. So we need to look around this and we need to measure it. Anybody, any question up to now? Okay, let's please. Okay, let's please. So we need to be look around this, so both we can compare and then we can make the decision. So next we can look around the financial statement of next and the Marks and Spencer and we can calculate the ratios. So it's good to be what we can do. We can copy this. We can look around the statement of financial year last year and this year. And these, we can compare two companies and we can make the decision either to invest or not. So I copied the link for you. So please go through. That will help you as well. Okay, then next we're looking develop a key performance indicator. So performance measurement is the monitoring of the budget or the target against the actual result to the establish how well business and its employees are functionally as a whole and as the individual. So performance measurement can be related to the short-term objective and the cost and the control, and the longer-term measures and the customer satisfaction. Objective and the goals of the business will be varied depending upon the types of the business. Type of the business. So we need to look around these. Every business have a different objective. The long-term goals are broken, can be down. So we have to look around what really business want to achieve in the long run as well, what their strategies are. So that's just the ratios itself. The company's performance can be compared to its previous performance and the past result as well. That also help us to measure the performance of the company, and the area of the weaknesses are we called area of improvement for the company. So that's we need to be look around. Next, guys, we need to look around. So next we'll go through horizontal analysis. So please, can we spend 2 minutes to just read? Okay, so that's we need to be look around the horizontal analysis. Try to be overcome the problem of the vertical analysis. Common compare the company performance for particular period with the performance are equivalent to company in the same period. So this is independent yardstick to comparison. So however the important pick the similar size of the company. It's not good you compare a small corner shop with a big company. Their ratios will be different. Try to be in the same industry, the same size of the company. That will help us to be compared properly. Okay, next we can look around industry average. So this type of analysis compare a company's result ratio to, so we can look around the average similar type of the company industry average. So you look around the KPIs. So like we discussed, KPIs is a key performance indicator and average and industry benchmark. All we need to look around. So like we said, liquidity ratio, current ratios normally a lot of analysts says it need to be 2 to 1. But 2 to 1 is not a hard and fast rule. £2 worth of asset and £1 worth of liability, but it varies industry to industry. Maybe in term of Tesco, if the fast moving goods, FMS, fast moving FMGs, fast moving goods companies, where the goods are coming and quickly sale, so we can look around, maybe there is a ratio 1 to 1. Yes, instead of less than. So we can look around industry, what other company is doing, then we can make the comparison and we can look around our performance and their performance. Okay, that's we need to look around. We look horizontal, we look industry average, and then we need to really read that strategy. The ratios maybe show the particular weakness of the company as the business plans to deal with these weaknesses. Turning a business around, making a changes can sometimes things can be worse because of the get better. The ratios focus in the past, don't always tell the story about the future. So impact of the decision, we often ratios about investing or lending businesses. You should consider the impact of doing so on a business ratio. For example, a profitability business with poor liquidity may be improved by taking a long-term loan. Okay, then we can look around when we measure the performance. So we're looking the financial performance, non-financial performance, balance scorecard in financial perspective, in the customer perspective, supplier perspective, and internal perspective. All we look under balance scorecard, benchmark industries. Another we look always look this user, investor, potential investor, lender, suppliers, customer, government agencies and public. They use information for different purposes, so we need to look around their expectation and what. So I copied the link for to look around the GSK. GSK is a GlaxoSmithKline, which is a big pharmaceutical company in UK. So what we can do, we can copy this link. So let's please copy this link, and you can look around the last 5 years at least, this company. So we can look around 2019, 18, 17, 16, and if you want more, you can go back as well. But we don't need it. In 5 years is quite enough time. So we can look around the profitability margin. What's happened is increase. When we look the gross profit margin is increased few years, and the cash profit margin is also increased. Return on capital employed increased from the previous. Current ratios is slightly dropped 1.42 to 1.39. Quick ratios also dropped. So we can look around. Interest cover ratios also dropped. And if we look, the inventory turnover ratio is increased. Debtors ratios is increased. So taking more days instead of less days. So inventory turnover ratios and fixed asset ratios, all we look, and then we can interpret them and we can make the decision. Either overall, this company seems really good to be invest because it's a growing and they have a very positive figures. So then we can look around the previous our example, Anika and Papika, interpret and report the result to the performance indicator. So based on the above examples and the ratios which we have calculated about Anika and Papika, so for gross profit is the better Papika, operating profit is the better in Papika, Anika is the less risky, Anika is the less risky in terms of interest and asset ratio, Anika. So as far as the profitability is concerned, Papika is better. If you take higher risk, you can earn the higher return. But keeping in view of, we are recommending to leave its main concern is the riskiness of your invest. So I would suggest to invest in Anika. Still the profit there, but there is a less profit than the Papika. So is lower risk is the lower profit is the better. If we can quantify the risk and we can look around in this case. So in based on these ratios, I suggest go for. And further, Lewis need to be look around the company future policy, their contract, future contract and all. Qualitative and quantitative measure assess to the performance of the companies. So that's we looking for point M. So if you want to be hit the merit criteria, so we need to look around. So the main objective of the financial statement help to economic decision. So user external business need to be interpret its financial statement to understand its financial performance, profitability, financial position, liquidity, and use of resources. If the assessment you have asked, calculate ratios, compare the set of ratios with the ratios of the previous accounting period, and industry averages, comments on the specific ratios, not whether the ratios is, and all this we can through this, the interpretation. And of course, we need to look around the strategies, and then further we looking for D is compare and contrast the financial performance. So we can look around different elements. So we have this question, we're looking the Nestle Limited 2 years. We can say 8 and 7 is quite old, but it still is worthy, to develop understanding. We can pick any year. Really, we can look around 2 years statement of financial position, which is also known as the balance sheet. And then we can further go down and we look the 2 years their ratios. So current ratios is this year 2017 or 7 was better than the 8, and we can look around asset test ratios is the year was better than this year. The trade receivable was better this year compared to the last and trade. So the current ratio is decreased during this year. The better liquidity situation is given. Quick ratio and the quick ratios had decreased. So the trade receivable is a lower, takes less days to collect. So that's all, and the basis of this we can move forward, and then we can make see in the company. The company has the poorer liquidity this year than the last year. That current ratio has fallen despite increase in the inventory. So we can interpret these ratios, and then we can make a decision to which one. The objective of the financial statement, we can look around what objective was, and we can look around the objective of the external user. We can look around different user. They can make different decision based on the financial these ratios. If anybody any question? Okay, then at the end I copied the link to be you further develop your understanding about the ratios and the use of the ratios. So please you can copy this link and you can play this quiz, those are listening. If you have any question, drop me email. So today lesson we learn different technique, we learn about the different types of ratio, profitability, liquidity, use of resources, and getting ratio all, and these are we learn about horizontal, we learn about qualitative and quantitative. Qualitative is the other information other than the financial, and quantitative is all the numbers. We can look around industry benchmarks, start NDAs, and the company's strategy for futures that will help us to measure the performance. And we need to look around the goodwill or some contingent liabilities as well in to make the final decision either to invest. If you have any questions, so please drop me email on my email address. In the next lesson we'll go through and we'll discuss about assignment brief, how we can address different learning these are learning outcome in within different tasks. If thanks for attending this lesson, and I hope so I will speak to you during our next lesson. Thank you. Bye bye.